Meantime, retail stocks are today's best performing group in the S&P 500. That is coming after some mixed news, though, on July sales. Laura Lee here now to break it down for us. And Laura, for the most part, investors are focusing on the positive.
Yeah, that's right. You know, the numbers were clearly mixed, with sales overall falling about 5% in July, according to the International Council of Shopping Centers. Now, that's the bad news. But some retailers, including Kohl's, Limited Brands, and discounter Ross stores, topped analyst sales estimates, and some retailers rang up enough sales last month that they're actually boosting their earnings forecasts, including Macy's, The Gap, JCPenney, and Kohl's popping up there again. And that's really been enough to get investors more optimistic about the outlook for these retailers. Now, August sales are expected to fall 4%, but Mike Nomura over at ICSC, says he expects the industry performance to only get better from here as the economy recovers.
So, Laura, let me ask you, even though sales are generally falling, we have seen some tremendous gains in those retail stocks. Mind you, they were coming off some very severely beaten down levels.
Yeah, absolutely, Carol. You know, and the buying really continued today, pushing the S&P 500's retailing index up more than 28% so far this year. So investors are clearly betting consumer spending will bounce back. But I do want to point out that investors are paying a hefty price on that bet. With this year's earning gains, retail stocks are now the most expensive since 2007, trading now at about 17 times earnings. So these stocks may not necessarily be a bargain for investors at this point. Back over to you.
All right. Unlike retail stocks, telecom shares are going in the opposite direction. In fact, they are the worst industry group in the S&P 500. Why? Well, for the answer to that, let's bring in Zara Burton. And Zara, a lot of this sell-off today really has to do with MetroPCS. Wasn't the pay-as-you-go market supposed to be doing better than the services that, required you to sign into a contract for a long time?
Yeah, Matt, and the pay-as-you-go market is doing better. If you look today at those earnings from MetroPCS, it was able to grow its sales by 27% compared to AT&T and Sprint, which we heard from in the last couple of days, last couple of weeks. They actually saw sales decline. The problem is they're not doing as well as analysts had expected, which is causing the shares. You're seeing that stock just sell off today about 29% to the downside, the most we've seen in 2 years. Not only did sales trail estimates, but earnings before taxes, depreciation, and amortization, that rose only 11% to $234 million. Again, missing estimates. The average monthly bill declining, customers seeking discounted plans to cope with this economic slump. Now, they're also dealing with increased competition from the likes of Sprint, which bought Virgin Mobile last month to increase its exposure to prepaid subscribers. But as you can see, Metro's loss isn't helping out any of those stocks today. Sprint today down. Sprint, AT&T, and Verizon all to the downside. Back to you guys.
All right, Zara, thanks very much for that.